Hey guys, All in Crypto here, and welcome back, beautiful people, for another YouTube video. This is going to be your daily cryptocurrency market update, where we try and navigate the treacherous waters that currently are the crypto space, the market landscape. We don't just do crypto analysis on this channel, we do sort of 360 cross-market analysis, as we cannot, and one thing that 2022 should have shown us is just have our blinkers on to crypto specifically. So it's what really differs us as a channel. Before we start, guys, if I can ask you to do me a massive favor, smash that like button and leave a comment for the algorithm. And if you're not already subscribed, it's well worth it. Hopefully, we've shown you guys that we're far more than just entertainers, which is what most YouTubers are. We are actually active investors, traders, and we do try our best to navigate the waters. We don't get everything right, but last year we were on the trade, being out of the market. This year, are we getting back into the market? Have we already got back into the market? Well, my Patreon's already well up to date on that, but I will share my investment thesis and where I'm at with you guys probably next week. So stay tuned for that. We're, of course, going to do some recapping on yesterday's events with the CPI. CPI day was pretty volatile. You know, the market's doing well. I think you're going to get a pullback, in my opinion, or some sort of a rest period before maybe you see that further continuation. You're at sort of this real resistance, and I think you're going to get a pullback, and then you're looking potentially to set up for continuation. And I actually think the dollar got killed off yesterday. The dollar's at some pretty significant support right now, just like when it was at resistance here. We did say, actually, look, you're going to get a pullback. Admittedly, didn't expect this kind of a pullback. We still are in dollar stablecoins and have been for nearly a year now. But maybe we will, or maybe we won't be looking to get out of them. But I'll share that with you probably next week. But I want to just really recap on what took place yesterday. So we had the CPI. CPI came out at 6.5. The prior one was 7.1. And it shows a real decrease in inflation. And this is something that we had actually looked at before the fact. And we've said, actually, if we go and look at wheat, if we go and look at natural gas, if we go and look at oil, they're all at pre-war levels. Now, they're not quite at levels from March 2020's printathon onwards, but they do look to be subsiding. And actually, you'll notice a real narrative shift in regards to inflation, in regards to the economy. You know, we had some pretty staggering news today that the UK economy ekes out growth in November, surprise, but recession still seems as inevitable. So we're getting good data in what's supposed to be a real bad time, and we got some really interesting things to show you in this one. This is Wall Street and Fed liquidity, and they're essentially front running all this good news and this kind of ease, and have been in regards to the kind of news that we're getting. But we've got a lot to talk about, so I really want to stay focused. Let's finish off on the inflationary stats. This is CPI shelter. So excluding the laggard shelter components, inflation has just about normalized. This is for shelter. What else do we have? We've got a number of things. We're going to talk about this as well, because why is this inflationary data so important? Well, because it's leading what the Fed are doing in terms of interest rate hikes. We know that interest rate hikes are, we can pull the Fed funds up on this just to show everyone this, even though we've done it a million and one times. You know, what's essentially causing markets to sell off? Markets front run rates going up because they know that it redirects liquidity out of them into the debt markets. And this is the whole game of investing, guys. It's all about following the money. And we are on that like a bloodhound, and essentially positioning accordingly. This is what fund managers do. So they all front ran it. All markets did the same thing, but now they're kind of suggesting. And one thing that we've suggested on this channel, looking at the 2-year yields, we've done a deeper dive with my Patreons, is that if this is topped at 4.8 and your Fed funds rate is at 4.1, it suggests that they don't even have another point in them to go. So the majority of the pain in terms of interest rate hikes is behind us. Yes, they still may have a little bit further to go, but you've got to understand that markets are forward-looking. You know, you can see Wall Street. Wall Street has even started front-running Fed liquidity, and you can see this is from cross-border capital. This is kind of what's taking place. So we've done all this speculation. One thing we do as market analyzers is look forwards and backwards. We 360 analyze the markets, and this is how we are able to position before many. And we have said as well, the thing is with crypto, you'll have a huge FOMO element kicking in right now. You'll have people aggressively feeling emotional right now. We try and cut that out. And that's part of what we do. We try and essentially look at this and say, okay, We think this is coming because of this, and this. I do weekly meetings every Sunday, and we analyse the sort of overall markets and try and navigate it. And last year, we got things pretty spot on. We got how the bull market ended wrong, but very quickly changed our bias, got on the right side, the side of the market. And this is an important thing with all these sort of super bears at the moment that we've said is you need to be humble in front of the markets. We did say since the start of the year, we're not bearish or bullish. You got the January effect. You've got a lot of things happening that may suggest or may, to me, highlighted that we shouldn't have been bearish going into this year. More, we should be neutral and let the market play its hand and we'll position accordingly. We still do believe that there is some sort of a horrific crash on the horizon, just like the yield curve's predicting. But the interesting thing with this is, and I'm going to do a full case study on this, probably release it Sunday morning, is if you add the S&P on here and you look at the yield curve and actually its deepest point, look at what markets do as it starts to come back up. And it's not until it's really in these areas that typically you get that crash and you get the sort of bottom of the market. You know, if you look at actually when your yield curve's at its low point, if you look at what the markets typically do, we'll do a full case study on this. Usually they'll go up for a bit before that crash comes down the line. So it doesn't mean that this one has to play out in a similar manner. You know, you've also got, in terms of the economy generally, this real sort of tricky landscape, because why are we seeing growth despite the fact that, you know, we've got this real harsh, restrictive by the Fed's own terms monetary policy? Well, it's because everything was locked down for 2 years and things are still somewhat getting back to normal. So there's that kind of element that's contributing to growth that people aren't looking at, and it may be sort of skewing data and actually throwing historical data out the window. Hopefully you guys are following what I'm saying here, because you know, this is real alpha, guys. But in terms of inflation, you also have the largest drop, I think, ever in used car sales. I know, for example, I have a car. At one point, I could have sold my car for more than I bought it for like 3 years ago. You know, now that isn't the case. I constantly get those little emails saying, you know, your car is now worth this much, or we'll buy your car for, you know, blah, blah, blah. And even sometimes phone calls. But yeah, so we got the lower inflationary figures. You know, we'd looked at JP Morgan's forecasting this and saying, okay, this is going to be good for markets. That's exactly what happened. You know, the stock market, which we haven't actually done too much looking at. We were more crypto focused because that's obviously where we're the market we're involved in. You know, done quite well off the back end of this. We spoke about this bullish div, low lows on the price, high lows on the RSI. You've got that for Bitcoin. And we also actually spoke about, and nobody else has really done analysis on this except for us, this stablecoin. We before this even broke, we looked at it and said you got your bullish div. This shows the trend. When you have bullish divs, it shows a trend is vulnerable or coming to an end or slowing down. You know, it's weakening in terms of conviction. That's what you've got. The momentum is waning. And this is something that we take very seriously on this channel. When you have these bullish divs, just like for Bitcoin, the big bullish div, of course, was here. That should have told you everything that you needed to know, and this trend actually wasn't at its sort of peak, and it was coming to an end, and then you got a bearish div here. So is that something that's playing out again? Potentially. Like I say, from an investment point of view, we're really just trying to comment on everything. From an investment point of view, I will up-to-date you with where I'm at next week at some point. I may even release an altcoin video a little bit soon and telling you what I'm doing. But things seem to have changed. And actually now, the German economy also grew, which people are shocked at. The US Senator Warren, before raising interest rates again, the Fed should examine the data. You've also got, this was from Michael Brown, who I think he works in the City of London. Quite a good guy to follow, actually. Markets think we get a 25 basis points in February post CPI report. So this is why this is so important, because people are looking and working out the sort of liquidity flow of things. And we can do this for ourselves. Look at the euro dollars. Euro dollars was up on the back end of that. Let's look at the Fed funds. Fed funds up. So if you end up in a situation, and I'll show you why this matters, guys. Bitcoin. Look at the bottom of, or the height of interest rates, and look at what happened when they started going up. Markets caught a bid on that. Now, of course, you know, and you can also see here, this is things that most crypto analyzers don't look at because they simply don't know that they're entertainers. Nothing more, nothing less. Some of them are very good at it, but they're not traders, analyzers, and actual. They might be investors, but is that what they do for a living? Is that what they call themselves? You need to commit to that, and they just simply don't know this. So, as a result of this lower print, you've had markets repricing, you've got liquidity repricing, and that's why we've seen the sort of rally that we've seen. And now you've got the whole sort of narrative shift, even though we predicted it based on the 2-year yields, that things are looking likely to change. And there's going to be a lot less harsh sort of policy moving forwards, which means that more sort of, benefits and liquidity to markets. And this is kind of what we're looking at moving forward. But we'll keep you up to date on the whole situation. I'm going to have to go, guys, because I'm really, really busy today. But stay tuned. Again, if you can do me a favor, smash that like button, hit that subscribe button if you're not already, and of course, leave a comment for the YouTube algorithm. That'd be greatly appreciated. I'm going to love and leave you on that note, guys. If you enjoyed the content, likes always appreciated. And so is a comment. See you in the next YouTube video.